Johnny.
Johnny.
J-O-N-E.
J-A-N-E.
Johnny.
Yeah, Johnny.
Johnny. Okay. Thank you. Good morning. What is your name?
Deja.
Deja. Okay. So, good morning. Today we have the most important class of this entire course. The reason this class is very important is we are going to cover stock valuation in details today in this. Also, whatever we cover in today's class is directly applicable to the project you are going to do. So remember, in this project, you need to evaluate 10 stocks in a group, right? And then over there, you need to apply a number of stock valuation techniques to find out the fair value. Then based on the fair value, you're gonna use the stock track platform to execute it, right? So today, I already gave you the solution. So today we are gonna pick CBS, and then based on the publicly available information of CBS, we are gonna evaluate its stock price. Then in each project, you are going to do exactly the same work, but for 10 different companies. And then you're going to find out the fair value. Then if your fair value is greater than the market value, then you're going to buy. If your fair value is less than the market value, you're going to do short sale. That's it. And then remember, by March 15, if I am not wrong, let me find out the specific date from his syllabus. So you need to register your team in stock trade platform before March 15. That means March 14, right? So I already formed a group. You can find it out from your Blackboard, and then contact with your group members and open the account over there. Now, yes.
Where did you where's the group system? Where
let me just show it will not show up from my end, but I can show you what group I already set up, and I can show you all the names over there. But in your Blackboard account, you can see your group name. So let me just
go to your Blackboard and you click on the class on the left hand side. It's going to be all the way to the bottom. It's going to say my group, and this is going to say project group. And then I think there's a number. Click on that, and it's just kind of like group home page or something. And then you can see the people that's thank you.
and also only for today's class, I'm going to post a class video so that even if your group members miss the class, they can check the Blackboard account and then do their homework before they actually participate in a group work. So obviously, whoever participates in the class should not take the extra burden. So therefore, I'm going to post the class in your Blackboard account only for today, and then your group member can check. And remember, also, I don't expect you to just execute some trades before the um, report submission date. I want to see consistent trading from March 15 to April 26. Of course, I don't want you to trade every single day or every single week. But if I see, okay, you just executed all of the trades in a single week, right before the term paper submission date, it could be considered as a red flag to me. And obviously, I'm going to take off some points. So what I want, so the way you can proceed here is you can start working on your stocks right after March 15. Then find out the fair value of 10 stocks in the next 1 week or 2 weeks. Then execute it trade. Or you can start with 2 to 3 companies and then find out the fair value, execute trades in the first 1 or 2 weeks, then start another 4 or 5 companies, So show me just some consistent performance. Okay, now then let us start. And also, I'm gonna open the homework for this particular chapter today. So you can check your homework and then finish your homework by the due date. So here, I already uploaded the solution for today's class. Even your group members can check here. Once again, these solutions are not only important for your midterm exam too, they are important for your project work. Now let us start. Okay. First one is a very basic question. I just copied it from your book and I thought it is very important for you for your midterm exam. So let me just solve it first. So here you can see this particular company pay regular dividend of $2.40 per share for the next 4 years. Then at the end of the 4 years, the company will pay out $40 per share liquidating dividend. And the company will cease operation. If the discount rate is 10%, what is the current value of the common stock? And then in the very last page of today's solution, I already compiled all the formulas you can find out. So here, these are the formulas we are going to use to calculate stock price using the dividend discount models. Okay. Now, let me just summarize all the information. So here, you D1, D2, D3, D4. That means dividend 1 year from now, dividend 2 years from now, dividend 3 years from now, dividend 4 years from now. And then price 4 years from now. Stock price 4 years from now. Now it says your regular dividend will be $2.40 in your very first year, $2.40 in the very next year, then $2.40 in your third year, then $2.40 in your fourth year. Then the company will give you one-time stock price of $40 per share. Now the question is, what should be the stock price? So here, the formula we are going to use is this. Here you don't see, we don't have any constant dividend growth rate pattern here for indefinite time period. You have constant dividend here, but this constant dividend will stop in year number 4. So this dividend will not continue for indefinite time. So therefore, we cannot use the other constant dividend growth rate formula. We have to use the basic dividend formula. So this formula says P0 equal D1 1 plus K. You can see here D2 1 plus K square plus D3 1 plus K plus D4 1 plus K to the power 4. Actually here, in each year, you need to actually first calculate the total cash flows you are going to receive for your stock investment. Then you need to actually discount all of those future cash flows you are going to receive for your stock investment to get your stock price. Now, in year number 1, your total cash flow is how much? $2.40, right? This year, right? So this in your first year is $2.40, right? In second year, your total cash flow you receive for your stock investment is how much? $2.40. Now, Jenny, next question. In year number 4, what is your total cash flow? And the price, because you're gonna get both, right? So does it make sense now? So basically, in every year, you need to actually consider the total cash flows you receive for your stock investment. Okay. So D1, $2.40. Here, your discount rate, let's say how much? 10%, right? Very good. 10%. $2.40, 1 plus 10% squared, then $2.40, 1 plus 10% cube plus $2.40 plus $40 with total cash flow divided by 1 plus 10% to the power 4. Does make sense now? Okay. Now, so you can use general calculator. I'm gonna do the rough calculator in Excel, but I'm gonna do it rough. No Excel specific Excel formula. So you see here equal $2.40, $2.40. Then you're gonna divide it by what? 1 plus 10%. So it is first one is $2.19. $2.19. Next one, $2.40 divided by 1 plus 10% square it is $1.98. Next one, $2.40 divided by 1 plus your 10% discount rate cube, right? $1.80. Next one, your $2.40 plus your $2.40 plus your $40 divided by 1 plus 10% to the power 4. The value is, oh, you are Diana, right? Yes. Diana. Okay. So have you received the same number? Okay. So now we are gonna just sum it up, right? So it is $2.19, $1.98, $1.80, $28.98. So this is how we get the total share price equal to $34.95. Okay. Now, first of all, do you have any question here? Now let us modify it a little bit. Okay. So the only information I changed here is this. So here we know the stock price, the dividend will be $2.40 in the next 4 years. Then the constant dividend growth rate then the constant dividend growth rate G equals to 3%. Now the question is, what is the current stock price? Easy. Okay. Now we are gonna approach this particular problem in 2 steps. In step number 1, we are gonna calculate share price in year number 4. Then the next question you may ask is, how can you determine in what year you are gonna first calculate the share price, right? Here is the answer. So you are gonna calculate share price 1 year before the constant dividend growth rate starts. So remember here, your constant dividend growth rate starts from year number 5. So once you apply your constant dividend growth model formula using this 5% constant dividend growth rate, you're going to get P4. That means price 4 years from now. Now let me show you the formula. Then your concept will be even more clear. So you all know this one is the constant dividend growth formula, right? Now, let me take it. Now, whenever you use dividend 1 year from now, you get what? Price right now. So basically, you actually step back 1 year, right? So now, let us modify this particular one. So here, if I use dividend 5 years from now, then what will I get here? Price 4 years from now. How? Look, with this is the original formula, right? So here with 1, I'm adding 4. That means dividend 5 years from now. Now, if you modify this, then you're going to get what? Price 4 years from now. So with this constant dividend growth rate, I'm going to get price 4 years from now. Why? Because my this constant growth rate will start from year number 5. So with this constant growth rate, I can calculate D5. Dividend 5 years from now. And then once you modify this particular formula, you are going to get what? Price 4 years from now. Then you're going to plug in this particular equation to get you share price. Now, is step number 1 clear? Now, let us calculate D5. So now here we know dividend up to year number 4, right? But at the same time, we know the dividend growth rate from year number 5 will be how much? 3%, right? So now we can use this one to calculate D5. Dividend 5 years from now equals dividend 4 years from now times 1 plus dividend growth rate. Basic, can you see from there? Because people join the class online can see this one better. Okay. So now, here, so is it clear? So with dividend 4 years from now and the constant dividend growth rate, I can obviously calculate D5. So here, let us now plug in numbers. So $2.40 plus 1 plus growth rate, which is equal to 3%, will be your D5. So you D5 here. So your D5 will be $2.40 times 1 plus 3%, which is equal to $2.47. So now we know D5, right? Now, let us go back and use this formula. So we know D5 equal to how much? 2.47. Thank you. $2.47. And then your discount rate will be 10% and your growth rate will be 3%. So $2.47 divided by 10% minus 3%. So your P4 will be equal to, let me write it down here. Your P4 will be equal to $35.29. Okay. Any question here? All right. Now it should be very easy for all of us. Now we are going to plug in numbers into our original formula. The formula we see here, right? So can you see exact same formula, right? D1 divided by 1 plus K, D2, D3, D4. Actually, these are the total cash flow, right? In each year. So in year number 1, you're going to get $2.40. Year number 2, $2.40. Year number 3, $2.40. Year number 4, $2.40. At the same time, you're going to get P4, right? Price. You're going to get this price. So this price plus your D4 will be your total cash flows in year number 4. Jenny, you? Okay, let us now plug in numbers. So your D1 is equal to how much? $2.40. Your K is equal to 10%. Then your D2 is equal to $2.40. And then your K is equal to how much? 10%. Then your D3 is equal to $2.40. K is equal to 10%. Then your D4 is equal to how much? $2.40. And then your P4 is equal to $35.29. Next, K equal to 10%, D4. You see, we just plug in numbers, right? Now let us calculate. So once again, your okay. So if you divide $2.41, it should be $2.40. If you divide $2.40 by 1.1, you will get 2.81. So 2.81 plus $2.40 divided by 1 plus 10% square. Second one is how much? $1.98. Okay, first of all, does it create problem if I do my calculation in Excel? Is it clear for you people? If it creates problem, let me know. Okay. Next, year number 3, $2.40 divided by 1 plus 10% cube. It will give you $1.80. Next, in year number 4, you have $2.40 plus $35.29. Then divided by 1 plus 10% to the power 4, you'll get $25.74. Then you just sum up $2.18 to $1.98, $1.80, then $25.74. Then your total stock price here is $31.70. Okay. Now, any question here so far? Now let us start the most important problem for today's class, not only for today's class, for this entire semester. So here I copied the financial information of CBS as of today. So if you go to, first of all, let me just show you how I collected all of this information. Then we're going to just match. I provided you the link here. All the web links are provided here in the second page. So for your company, whatever 10 companies you select for your group, you can use both Yahoo Finance and Morningstar, what I'm going to show you now, and then collect all the financial information. Okay, Tiana? Okay. Now, yahoofinance.com. CVS. CVS is the ticker. Okay. So this morning, their stock price was $69.03. It has changed a little bit. Now, you can see here, they provide you the information of beta, stock beta, 0.81, right? All of these information are very important. I need beta to solve the problem. You can see here in the second page, not in the second page. Whenever I'm gonna start the problem, you're gonna see. So you, first of all, remember, you can find your stock beta in the very first page. Next, you can find your dividend also here. You can see here, dividend of this company was $2, right? Next. So let us see now. What you see here first, return on equity, right? So I'm going to show you every single financial information I have here so that you can collect it for your own companies too. And once again, if you have any question, stop me because it is very important. So return on equity, right? %10.76%. Clear? Once again, here, you can get all of this information in the statistics tab. So go to the statistics tab and then scroll down to find return on equity. Next, debt to equity ratio, right? So your debt to equity ratio is here. Next, your shares outstanding. Here is your shares outstanding in the same page. Then revenue per share. You see, revenue per share, same page here. Next, diluted EPS. Next, free cash flow per share. Here you get levered total free cash flow, right? For this, you need to do some calculation. So please give your attention. Here you get levered free cash flow. Levered free cash flows equal to how much? 21.87 billion, right? At the same time, from the same page, you know total shares outstanding is equal to how much? 1.31 billion, right? Same in the same page you can see here. Share outstanding is how much? 1.31 billion. So shares outstanding 1.31 billion. Then you can actually calculate free cash flow per share. How? You divide total free cash flow divided by number of shares to get free cash flow per share. So how much is it? $9.82. So that is what you see in your Word document. Okay. Next one. Oh, let me just correct it. Total free cash flows divided by number of shares outstanding. So you can correct this one. Next, book value per share, right? So your book value per share is here. Here, book value per share, $52.97, right? Next one is debt per share. Once again, here you know your total debt. Your total debt is how much? 85.04 billion. So your total debt $85.04 billion, and you know your total number of shares outstanding, right? So divide total debt by total number of shares outstanding to get your free cash flow per share. You can see here in your Word document it is $64.92. Yeah. Okay. Is it clear? How do I get total debt per share? Okay, good. Next, sales growth estimate. Earnings growth estimate. So for this, we are gonna use the different tab in the same web page. So here, you are gonna go to analysis tab at the very top. Then scroll down. So here you can see sales growth estimated for this particular company for the next year is how much? 4%. Is it clear? Then earnings growth estimate. So your earnings growth estimate for the next 5 years is how much? 3.81%. Okay. Then free cash flow growth estimate. The good part of today's class is once you're going to use these tools to actually do your own trade using the stock track, you can find out if you can use these techniques profitably for your own investment or not. But once again, I'm not recommending you to do it, but I'm saying these are the real tools we use. And I'm showing you the valuation of real companies. Now, free cash flow growth rate. For that, we are going to use Morningstar. So let us go to Morningstar. So Morningstar, let me see. So here, Morningstar. Then we are going to search CVS, right? Now, go to the Financials tab. Financials. Then scroll down. You can see here they provided the free cash flow for the last 3 years. 6.83, 10.39, 13.43. So using these three numbers, we can actually calculate average growth rate. So it is 6.83 in 2018, 10.39 in 2019, 13.43 in 2020. Now let us calculate growth rate. So growth rate from 2018 to 2019, right? First one. So first one, we are going to calculate growth rate from 2018 to 2019. Then we are going to move to 2019 to 2020. Then we are going to take the average. And once again, the free cash flow growth rate is not available for the free version. But if somebody actually subscribe for the Morningstar, they actually provide the real free cash flow growth rate. Okay, let us first calculate 10.39. So divided by 6.83 minus 1. This is how we calculate growth rate. Remember the growth rate formula is what? New value minus old value divided by old value. Or if you break down this formula, this is what we get. New value divided by old value minus 1. So both formulas will give you the same answer. You can use either of them. Okay. Next, once again, new value minus old value. Old value means the value in the previous year. So value in the previous year is how much? 10.39 minus 1. So these are your growth rate. Now, let us take the average. So here, 0.5212 plus 0.2925 divided by 2. You're going to get what? Your average. Let us convert it into percentage. This now in the decimal place, right? So to convert it into percentage, we need to multiply the decimal by 100. Then you're going to get percentage. So your percentage free cash flow growth rate is how much? 40.69%, right? Next, 5-year average PE. So here, valuation, then move to the valuation tab. Then here you can see they provide you price to sales growth rate. I'm sorry, price to sales ratio for the last 5 years, 0.41. PE ratio, 16.32. Price to cash flow ratio, 8.09. They also provide you other ratios like earnings yield, enterprise value to EBIT ratio, enterprise value to EBITDA ratio. So if you want, you can even use those ratios to find your expected share price. Okay. And then if I get time in today's class, I'm going to show you also how to use this EV/EBITDA ratio to calculate your share price. If I don't get time, basically the formula is here. So here, so this is the formula for EV/EBITDA, right? And as I showed you in the last class, you can write it down. So if you know your EV/EBITDA ratio, then what you need to do? You need to multiply to get your EV. You need to do what? You need to do this. I discussed it in the last class. So still, let me show you. EV/EBITDA ratio times your EBITDA. EBITDA means earnings before interest, tax, depreciation, and amortization. So EBITDA stands for earnings before interest, tax, EBITD, depreciation, and amortization. So if you know your EBITDA and you know your EV with the ratio, you will get EV. If you multiply both, you are going to get EV. Then from EV, the way you can get share price, total share price. So total market price of shareholders equity equals EV minus total debt let me just put it in a bracket. Total debt minus total cash. So actually EV minus net debt. So once you deduct total cash from total debt, we call it net debt. So this part is net debt. Net debt equal to what? Total debt minus total cash. So once you take the difference between enterprise value and net debt, you are going to get total market price of shareholders equity. Then share price equals total market price of shareholders equity divided by total number of shares outstanding. Is it clear? So these are not something very hardcore concept. Once you understand each of these concepts, then all of these formulas should immediately make sense. So once again, you know EV with the ratio. Once you know your EV with the ratio, you can get it from Morningstar. I showed it to you. Once you know your EV with the ratio and you know your estimated EBITDA, you can multiply both to get your expected enterprise value. Then, to get the share value, what you need to do, you need to actually deduct net debt from the enterprise value. Then you are going to get your total shareholders equity. Then to get individual share price, you need to divide total market price of shareholders equity by the total number of shares outstanding. Is it clear? Okay. Now let us move on. Okay. So now you know from where I get all of these numbers, right? Next, right now, you know the statutory corporate tax rate is 21%. So this tax rate should remain the same for every single company. Corporate tax rate should always be equal to 21%, even whatever company you pick. Of course, those companies should be US companies. Next, stock market VIX premium, you can assume for your own stock. You can also assume stock market VIX premium equal to 7%. T-bill 90 days rate is 3%. You may say currently a 90-day T-bill rate is less than 1%. But remember, this economic situation is something very volatile. So the current real T-bill rate is not the true T-bill rate we should use for our estimation. So usually, T-bill rate remains around 3%. So for your own companies too, you are going to assume the T-bill rate is equal to what? 3%. Stock market VIX premium equal to how much? 7%. Corporate tax rate equal to 21%. Okay. Now, as long as you understand all of this information, the calculations we are going to do next should be very easy. So therefore, before I proceed, I just want to ask you, do you have any question about whatever I discussed so far? Any question? And can you actually extract information for your own companies too? Okay, thank you. Now, we are going to estimate share price based on all of these processes or methods. First one, DDM with calculated sustainable growth rate. Next one, DDM with analyst forecast growth rate. The third one is DDM with two-stage model. Fourth one is residual income model using the sustainable growth rate. Next one, residual income model with analyst forecasted growth rate. Next one, free cash flow with historical growth rate. Then we are going to also use 3 different price ratios to calculate stock price. Okay. Before we calculate, let us calculate discount rate for equity holders and then discount rate for all the securities holders of a firm. Okay. So we are going to first calculate discount rate. Okay, so I have already provided you all the calculations. So since it is very important to understand the concept, you can keep your eyes here and ask me the question. If you want to take note, you can take note. But this is my suggestion. I have already provided you all these calculations. My assumption was if you keep your eyes here, you can understand the concept better. Then you already got the calculation. So the discount rate here. So remember, for discount rate, we are going to use CAPM formula. So we already discussed it in your last class. So CAPM, capital asset pricing model. CAPM, according to this model, required return on equity, or cost of equity, whatever you say. Cost of equity or return on equity is equal to what? US Treasury bill rate or risk-free rate. So this US Treasury bill rate is a proxy for risk-free rate. So for risk-free rate, we use what? 90 days Treasury bill rate. So actual formula is what? Risk-free rate plus stock beta times market risk premium. Now let me break it down a little bit further. Market risk premium is the difference between average market return and risk-free rate. Is it clear? So you can take note of all of this. Oh, sure. Thank you. So let me know whatever way it is convenient for you. Is it good now? Okay. Now let us calculate cost of equity. So to calculate cost of equity, we need to know US T-bill rate. And how much is US T-bill rate here? 3%. Very good. Then your stock beta. To get your stock beta, remember you need to go back to the original window. I just copied it from the Yahoo Finance, you know, right? So let me just show you. Yahoo Finance, here, summary, the very first tab. So I just copied it. So here you get your beta, right? Beta equal to 0.81. So you can see, I just copied it this morning. .81. Then stock market risk premium is equal to 7%. Very good. So once you calculate, here you will get 8.67%. If you want, you can even calculate by yourself. Very straightforward, right? 3% risk-free rate plus market beta times your stock market risk premium. So this should give you what? 8.67%. Basil, do you have any question?
About the stock market risk premium.
It is here.
Oh, it's already given.
Yeah. So as I said, even for the companies you're going to choose for your own stock investment for your project, you're going to use stock market risk premium equal to 7%. Okay. You'll also use treasury bill rate equal to 3%. You'll also use corporate tax rate equal to 21%. So this should be standard information. Yes, Jenny.
Where did you find that information?
Okay. So first of all, this stock market risk premium we get from your historical stock market return. So remember, the proxy we use for your stock index, market index is S&P 500 index. Just meet your curiosity, I am showing it, but you don't need to do it. So, but I can tell you these are really, really good tools to use. So it's good to know. So here, first type S&P 500. You get here, right? Index. Go there. then historical data. So from here, collect last 5 years information. Last 5 years information from here, and then download it. Then calculate return. So basically from these historical prices, calculate average annual return. Is it clear? So you get this index price here, then you calculate return, convert it into average annual return. Then now you also need to know what? Risk-free rate, right? Then you will get treasury bill rate from Federal Reserve. Here. So this is the Department of Treasury. And remember, we are going to use 90-day treasury bill rate, right? As our proxy for risk-free return. So here, just a moment. Okay.
So like for the ones that we're doing for our project,
You can use 3%. So I'm just meeting the curiosity of Jenny. It's good to know. Okay. So here you can see the 3-month rate is now, let me see. Okay. So the 3-month rate is now around 0.12% or something like that. But remember, we are now in deep hole in terms of our economic situation, right? So therefore, Federal Reserve Bank actually reduced the rate. But usually, in strong economic condition, it remains around 3%. So we are going to use 3% rate. Don't use it. But now Jenny knows, right? You can get it from Federal Reserve Bank. Okay. Okay. Now, let me now go back. So now you know your cost of equity. Now we are going to calculate weighted average cost of capital. Weighted average cost of capital. So to calculate weighted average cost of capital and use a capital asset pricing model to calculate the weighted average cost of capital, we need to know asset beta. In our last class, we discussed like whenever you want to calculate the discount rate for the overall firm, you need to use what? Asset beta. Now, let me show you how can you calculate asset beta. So this is the formula which actually shows the relationship between equity beta and asset beta. Now, let me just take it from here to this particular page, and then let us now replace values here, right? So what is your equity beta? Your equity beta is 0.81, right? Thank you, Basti. Yes. Now, we don't know our asset beta, right? We also know our debt to equity ratio. Where? Let me just show you our debt to equity ratio. So here our debt to equity ratio is how much? 122. Yeah, I mean, let me just show you. Okay, I forgot to change it. Okay. Okay. So we are gonna use, so basically, don't use the information in this table. Use the information we have here because these are the today's information. I showed it to you, right? But whatever information you have here, they are the information in 2019. Okay? But they are also solid information for CBS. But these information are for 2019. But whatever you have in your Word document is right. This one is for today. So you're right, we are going to use 122, but I'm going to update this particular Word document once we finish the class. So you're going to get the up-to-date document once you check. So 122.01. Then what is our tax rate? 21%. Remember here, our tax rate is how much? 21%, right? Okay. So now can you calculate equity asset beta? Yes, you can. How? Now let us do the calculation. So first of all, we are going to calculate this part. So this part is equal to 122.01 times 1 minus 21%, right? This part, 122 times 1 minus 21%. Next, plus 1. So our value is, sorry, let me show you, 96.3879 plus 1 equal 97.338. So let me replace it by 97.38. 97.39. Okay. So now you know asset beta is equal to what? 0.81 divided by 97.89. We are doing cross multiplication, right? Asset beta equals to 0.81 divided by 97.39. It is equal to 0.01. 0.01. Is it clear now? Okay. So now we are going to calculate, first of all, this one is asset beta. So here we just calculated asset beta. Next, we are going to calculate weighted average cost of capital. For weighted average cost of capital, once again, we are going to apply the CAPM model. But here, in place of stock beta, we are going to use asset beta. Is it clear? We are going to use CAPM model. Yes.
I don't get 0.01.
How much you get, Basil?
Something else.
So first of all, for this particular factor you have here, we have 97.39. How much do you get for that? First of all, here multiply 122.01 by 0.79. Then add 1, you should get 97.39.
So 0.81 divided by 97.39, right?
Yeah.
Probably the calculator.
Have you got the number? Okay, good. Once again, if you have any question, stop me and ask me the question. We are gonna solve it together. So now, Basil, have you got this WACC formula? Okay. So now we are gonna replace numbers here. So our risk-free rate is how much? 3%, right? Tiana, what is our stock market risk premium? 7%. Very good. So we get it from the second table, right? Then our asset beta is how much? 0.01. Very good. So once you solve it, the value you're gonna get is 3.06%. Okay. So we are done with our cost of equity and WACC. Then we are gonna start all of these models and then calculate our stock price. So before we calculate, let us take 10 minutes break. And in between, I'm gonna also upload the right Word document so that whoever joined the class online can get it now, and then we're gonna do it together, okay? So take 10 minutes break. I'm gonna go back to my office door. So we are gonna meet at 12:21. Thank you. Okay, let us start. So those who join the class online can actually go back and check week 6 folder, and then week 6 folder, and then download this problem solving document again. So here the only part I updated is this table. So now we all got the same table and we are gonna work with the same number. Okay, now here you can see we are gonna use DDM model, which is dividend discount model, to calculate the share price. So let me first copy the formula for DDM. So this one is the formula for DDM. Now here we need to know D0, which is our current dividend. And we already know our current dividend is equal to how much? $2. You can see here in the very first window, how much is your dividend? $2, right? So we get it from the very first page of Yahoo Finance. You can see here the dividend is how much? $2. Okay. Now, the only part which is missing here is the growth rate. So here, as it says, we are going to use sustainable growth rate. So the formula for sustainable growth rate is ROE times retention ratio. And as I discussed, the retention ratio is equal to 1 minus dividend payout ratio. We discussed it in the last class. So dividend net income. Okay. Total dividend divided by net income. Or you can use also dividend per share. If you use dividend per share, then what you need to do? Dividend per share, then you need to use earnings per share. So once again, if you divide total dividend by the number of shares outstanding, you get dividend per share. The same way, if you divide net income by total number of shares outstanding, you get earnings per share or EPS. Okay. Now let us first calculate retention ratio. Then, so your dividend per share is $2. You already know. Then your earnings per share here, EPS, is how much? $5.46. $5.46. Once you solve the formula, you are gonna get 63.37%. So now you know your retention ratio. Let us now calculate sustainable growth rate. Once again, in your project, you need to show me all of these calculations for all the 10 stocks you have selected. So here your ROE or return on equity. Return on equity is how much? 10.76%. 10.76%. Retention ratio 63.37. Once you solve the formula, you're gonna get sustainable growth rate equal to 6.82%. Jenny, any question here? Is it clear? Is it simple? Actually, it is simple. Seriously, if you understand the concept, it is simple. But if somebody does not understand the concept, it is something tricky. Okay, now we are going to replace numbers here. So D0, you know, is equal to dividend, equal to $2, right? And the sustainable growth rate we calculated here is how much? 6.82%. Then your discount rate is cost of equity. Your cost of equity is how much? 8.67%. Very good. Your growth rate again 6.82%. So once you solve it, it will be $115.39. So these calculations are very straightforward. I am not doing the calculation here. If I do the calculation, we cannot finish the class. But you know, these are simple calculations, right? But once again, if you have any problem or any confusion about the calculation, raise your hand. I'm going to do it here. Okay. Now, so our very first price estimation is how much? $115, right? So we are going to use now the second approach to calculate the price of CBS. Okay. In this case, we are not going to use sustainable growth rate. We are going to use analyst growth rate forecast. So remember, we found the earnings growth rate estimate from Yahoo, right? How much is it? 3.81. Remember, these are real numbers. 3.81. Then we are going to determine, like, if at the end of this class, we are going to determine if CBS is undervalued or overvalued. So your growth rate here is 3.81%. Your discount rate again 8.67%, right? Cost of equity. Your D0 is how much? $2. Is it clear now? Okay, then the price we get here is $47.72. Tiana, do you have any question here? Okay. Now we are gonna use two-stage dividend growth model. Remember, in two-stage dividend growth model, we have two growth rates. One growth rate will stop sometime in the near future. The second growth rate will continue for indefinite time period. First, let me copy the formula. Then let us determine which one is G1, which one is G2. To know G1 and G2, I need to go back to Yahoo one more time. So in Yahoo Finance, go back to analysis part, and then let me just show you something. So here you can see the earnings growth rate forecasted is how much? 3.81%, right? We all know. But in the bracket, it says what? This growth rate is applicable for the next 5 years, right? Is it clear? So this growth rate will stop 5 years from now. So this should be our G1. Next, as the name says, sustainable growth rate. So sustainable growth rate is something which a company can sustain or preserve or maintain in the future. Is it clear? So this sustainable growth rate should be our constant growth rate for the indefinite time period. That means second growth rate. So the sustainable growth rate should be our G2, and then analyst forecasted growth rate should be our G1. So as long as it is clear to you, then the formula should make sense to you now. Okay. So let us now replace all of these numbers here. So D0 is how much? $2, right? Then our G1, which is analyst growth rate, analyst forecasted growth rate, 3.81%. Our discount rate is how much? 8.67, right? 8.67%. G1 is how much? 3.81%. Once again, G1, 3.81%. K is equal to how much? 8.67%. T is the time period up to which our very fast growth rate will continue. So our very fast growth rate will continue for how many years? Basil?
5 years.
Yes. So the very fast growth rate will continue up to year number 5. So T should be equal to what? 5. Very good. G1, you know, it is 3.81%. K is equal to what? 8.67%. T is equal to 5. D0 is equal to 2.00. Now G2, this one is our sustainable growth rate. So our sustainable growth rate is how much? 6.82. Thank you, Daisy. Daisy, right?
Deja.
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 D-E-J-A.
Okay, so I'm from different countries, so if I've mispronounced, forgive me. Deja, right?
Deja.
Okay. Even I can tell you, you guys will find it hard to pronounce my real name. But as long as we understand each other, it's fine. So 6.82, then 8.67%, G2 is equal to 6.82%. Okay. Now I'm going to show you the calculation of this one, because this one may look a little bit complex, right? So let us calculate. So we are going to break it down. First, we are going to calculate this part. Then we are going to calculate this part. Then we are going to calculate this part. So you see, we are now breaking it down into 3 pieces, right? So let us do it. So for this one, let me open the Excel file. Oh. Here. So first of all, $2 times 1 plus 6.82%. So $2 times 1 plus 6.82%. You'll get something, right? So that number is $2.13. Then you're going to divide $2.136% by the difference between 8.67% minus 6.82%. Right? Next, now we are going to calculate this part. So this value of this part is how much? $115.48. Let me write it down. $115.48. This part, just this part. Now we are going to calculate the value of this part. So 1 plus 3.81%, you are going to get something. Then 1 plus 8.67%, again you are going to get something. Then divide the 1.0381 by 1.0867. So this value says 0.9552. Let us keep up to the 4 decimal place. So we are going to keep up to 4 decimal place. So equal 0.9553 to the power 5. It should be equal to 0.7956. Okay, 0.7956. So this is the value of this one. Now we are going to move to this part. Again, 1.381, so equal 1 plus 3.81% should be equal to 1.0381. 1 plus 8.67% should be equal to 1.0867. Then divide 1.0381 by 1.0867. Is the calculation clear? It is not something difficult. I'm just following my own sequence. You may have your individual sequence too, right? Next, 0.9553 to the power 5. So this is the value of this one. Then I'm going to take 1 minus this value. So equal 1 minus 0.7956. So it should be plus 0.2044. We have one more factor, which is this one. So equal $2 times 1 plus 3.81%. Then divide this $2.0762 by the difference between 8.67% and 3.81%. Then you're gonna get here $42.7202. Now we don't have a space now. So before I proceed, the value of this one is how much? $115.48. The value of this one is how much? 0.7956. Then the value of this one is how much? 0.2044. Then the value of this one is how much? $42.72. Is it clear, Jenny? Okay. Now let us calculate the aggregate value. Oh, I don't have space. So equal $42.7202 times 0.2044 plus 0.7956 times 115.48. So the value here is $100.61. Yeah.
For the exam, or like if we have to calculate something like this, is there gonna be like some sort of leniency as far as rounding goes? There on the screen, you have 100.61, and here the packet is 100.5.
Yeah. So basically, you will see like whenever I'll give you the options, they'll have some good difference from one other. So basically, then you can actually find out the closest one. But obviously, the difference will not be too big, like $2, $3, $4. No, the difference could be few cents, so that you can actually round it to the nearest number. Now we are going to use residual income model. And then in the very first model, we are going to use sustainable growth rate. In the second model, we are going to use analyst forecast growth rate. And you already know what is sustainable growth rate and from where we get analyst growth rate, right? Okay. So first, let me copy the formula. Now, let us replace values here. So B0 means book value right now. So if you go up, you will see book value per share is equal to how much? $52.97. So $52.97. Then you EPS 0. That means EPS right now is how much? $5.46, right? $5.46. Then your sustainable growth rate. Your sustainable growth rate is 6.82%, right? Next, your B0, again, it is $52.97. Now your K, so the discount rate you are going to use in residual income model is what? Cost of equity, remember. So here your cost of equity is 8.67%. Okay. Once you solve the problem, the value you're going to get is $119.94. Next, we are going to apply the same formula and similar approach. The only difference here will be, in place of sustainable growth rate, we are going to use what? Analyst forecasted growth rate. Okay. So again, your B0 is equal to how much? $52.97. Your EPS 0, that means EPS right now is $5.46. Your growth rate forecasted by analyst is how much? 3.81%, right? Again, in your residual income model, you will always use cost of equity. Now B0 is $52.97. Your K is 8.67%. Okay. Now the value you are gonna get from here is $75.10. Okay. Now let us move to the next problem. Free cash flow with historical growth rate. Now, before I start this particular approach, let me just discuss whatever we discussed in the very last class. Free cash flow is the cash flow which is available to all the securities holders, including debt holders, preferred stockholders, then equity holders, after the firm pays off for its capital expenditure and operating cost. So once a firm pays off operating expenditure and then capital expenditure, whatever cash flows are available, they are free cash flows. And then these free cash flows are available to all the securities holders in a firm. And those securities holders include whom? Debt holders, equity holders, preferred stockholders. Now, since free cash flow to the firm is available for all the securities holders, therefore, the discount rate we are going to use in free cash flow formula should also be the discount rate which is applicable to all the securities holders. Does it make sense? So the numerator and denominator should be what? Compatible, right? Now, the discount rate which is applicable to all the securities holders in a firm is what? Basil, do you know? It is weighted average cost of capital. And we already calculated weighted average cost of capital. Now, is the concept clear? Okay. So again, for free cash flow, we are going to use constant dividend growth model. Free cash flow to the firm. But the only difference here, in place of dividend, we are going to use what? Free cash flow to the firm. Is it clear? Now let us replace numbers here. So we already know free cash flow to the firm in the current year. It is how much? $9.82, right? Then we also know our free cash flow growth rate. So the growth rate of our free cash flow is how much? 40.69%, right? Then our weighted average cost of capital is how much? 3.06%. G again, once again, is 40.69%. Now, Tiana, you're going to answer this question. But once again, if you guys don't know the answer, it's fine. We are going to just discuss together and learn it, okay? And once again, I even don't know answer of all the questions in this world. So it's okay. Now, if you check the original formula here, I posted, you can use this particular formula only if your growth rate is less than your discount rate. Is it, first of all, is the context clear? So here I am giving the context now, right? So to use the this particular formula, your growth rate must be less than your discount rate. Now let us go back to the numbers we have. So here our growth rate is 40.69%, whereas our discount rate is just 3.06%. Now, based on the information, can we use the formula? No, you're right. But still, we are going to use it so that I'm going to use it in this class so that you know whenever you have the problem, how to solve it. But remember, for this particular company, actually, you cannot use the price. We are going to estimate based on this model. Is it clear? But the reason I'm showing you the solution of this particular approach is so that you can use this particular approach for your own companies, provided the condition is met. Is it clear? So in your exam, I may just simply give you these two numbers. Say for example, your growth rate is 3.06%, and then your discount rate or weighted average cost of capital is 3.06%. Then your growth rate is 40.69%. Now the question will be, can you determine price based on free cash flow model? What should be your answer? It is not determinable. Is it clear? Okay, now once you solve this problem, the price you're gonna get is negative $36.73. Now, this price is actually firm value per share. Firm value per share is equal to negative $36.73. Now we want to calculate stock price per share, right? So stock price per share is the difference between firm value per share and debt per share. Is it clear? Okay. So now let us replace number here. So I'm not giving you this formula in your formula sheet because this is a very simple concept. So total firm value is the combination of total debt value and total equity value. So now you know your total firm value. So if you know your total firm value or firm value per share and debt value per share, then you should be able to calculate stock price per share. Does it make sense? So once again, the concept is what? Firm value is the sum of shareholders value or total stock value plus what? Total debt value. Clear? So your firm value per share is negative $36.73. Now let us retrieve the debt value per share. So here you'll see debt value per share is how much? $64.92. How much? $62. No, $64. $64.92, right? So the value then you're gonna get here is negative $100.65. So stock price per share is how much? Negative $100.65. Once again, we cannot use this model. You already know, right? So now.
So for this one, that price wouldn't be right. You're just doing it to show us like how you work.
Exactly, because for your companies, maybe this model is applicable, right? So there, how basically you can follow the exact same approach to calculate the share price. So here, the shortcut method is if your stock price is negative, you cannot use the model. Stock price cannot be negative. Is it clear? So here my stock price is negative. So I'm not going to use this model. If your stock price is positive, you should use the model. Yeah.
So are we required to, like, is this piece a requirement if we can use the model for our company?
What is the question, Tiana?
The free cash flow model?
Yeah, you are required to use it.
And then if it's not applicable because of
it's still showing the calculation. Remember, Tiana, by showing me the calculation, basically you are going to do the practice, and it is going to help you for your exam. Because whatever homework you are going to see today will be actually related to whatever we are covering here, right? And at the same time, you're going to face similar question in your midterm exam and final exam. So therefore, it's better to practice. So just for practice purpose, you just show me the calculation. But in my opinion, I don't care. Because I know if the stock price is negative, you are not going to use the model. But for your practice, show me. Yes, please.
So like you were saying, we're just using it to just see like if it's going to be negative or positive. There isn't like another free cash flow model that we're supposed to be using.
Okay. So for this particular example, this is the only model you are going to use. But remember, let me just show you because this is a very good question. Deja, right?
Deja.
Okay. I'm gonna remember your name. It is gonna take some time. Okay.
I'm gonna say if it's easier, you can just call me by my middle name. It's a lot easier.
Which one is that?
Ray.
Ray?
Yeah, it's a lot easier.
Yeah, it is very easy. I don't have any short name. In my country, they always call you by your name.
Same, I don't have a nickname.
So just to answer the question, there is a Ray just raised. I'm just showing you this one. So don't mix it up to the problem we are covering right now. So there is a Ray. Sorry. Another way is, say for example, for this particular example, it is not applicable because here we know our free cash flow growth rate and we know our current free cash flow. So here our assumption is our free cash flow will grow at this particular rate for indefinite time period. So provided this is the case, you must have to use the formula we use now. But in some cases, you can have something like this. You know your free cash flow 1 year from now. You know your free cash flow 2 years from now. You know your free cash flow 3 years from now. You know your free cash flow 4 years from now. Then you know your constant free cash flow growth rate. Then you're going to apply the same approach, exactly the same approach to calculate your D5. I mean, free cash flow in year number 5. Remember, you have free cash flow growth rate in from year number 5 to indefinite time period. So once you determine your D5, I mean free cash flow 5, let me replace it so that I even don't mix it. FCF 5, FCF 4, FCF 3, FCF 2, FCF 1, right? So once you determine this, then basically, remember, let me just go back to the problem we solved in the class. Oh, it is not here. Okay. Just let me just solve the same problem. Okay. Now, so now here, we have free cash flow in year number 5, right? Free cash flow in year number 5. Then, okay. Not this one. With this one, you will get confused. Let me just copy the other one. So, free cash flow, if you multiply free cash flow in year number 0 by 1 plus growth rate, you get what? Free cash flow in year number 1, right? So, same formula. So, I'm just copying the other part of this formula. Now, you know free cash flow to the firm in year number 5, right? 1 plus 4, 5. Then this, the price you're gonna get based on this model is what? P4, right? Okay. Now let us replace number here. So your free cash flow in year number 5 is 2.47. 2.47. Your, in this case, you're going to use weighted average cost of capital. Why? Because your numerator here is what? Free cash flow, which is applicable to all the securities holders, right? So the discount rate and the free cash flow you're going to use should be compatible. So weighted average cost of capital, say for example, in this case is 10%. But remember, this discount rate then must be what? WACC, weighted average cost of capital, right? Now, your growth rate is 3%. Now, using this formula, you're going to get some value. Let me calculate it. So here equal 2.47 divided by 10% minus 3%. So it is $35.29. Okay. Now, you're going to use this model. This is the standard time value of money model.
Okay, so it's basically like the one that we did earlier.
Exactly, exact same thing. In place of dividend, you're going to replace it by free cash flow to the firm. But remember, the discount rate should be what? Weighted average cost of capital. Is it clear here? Okay. Do you want me to continue? Okay. How about you people? You understand, right? Okay. Now, let us calculate share price based on some price ratio analysis. So in this case, we are going to use 3 models, including price earnings model, price cash flow model, price sales model. Okay. Now, so the formula here should be, I'm not providing you this formula in your formula sheet because this should be very easy and should make sense, provided you understand the concept. So here, you know your PE, price earnings ratio, PE. So provided you know your PE, your expected share price should be equal to your PE ratio, then times your expected earnings in year 1. Now, in place of expected earning, let me make it more precise. Expected EPS, earnings per share. So you need to know your EPS 1 year from now. You need to know your benchmark PE ratio. Then once you multiply both, you're going to get your expected share price. Clear? The same way, whenever you use price cash flow model, to get expected share price, you need to know price to cash flow ratio, your benchmark price to cash flow ratio. Then you need to know your expected cash flow 1 year from now. The same way, whenever you use price to sales ratio, then you need to know your price to sales ratio. Then you also need to know your expected sales price, expected sales revenue per share. Okay, let me also replace here cash flow per share. So Basil, Tiana, and then Jenny and Daisy here I made some changes. It should be expected cash flow per share. And then here it should be expected sales revenue per share. Once again, over there, expected earnings per share. Now, let us calculate expected share price then. So the P ratio we have here is what? 5-year average P ratio is how much? 16.32, right? So we are going to use this P ratio. 16.32. Then expected earnings per share. So the formula to calculate earnings using the growth rate is this. So for any type of cash flow, say for example, you want to calculate cash flow n years from now, then you can start with CF0, 1 plus your growth rate, whatever growth rate you have, to the power number of years. So this is the formula. Now we are going to use this formula for every single case we have here. Now, in the very first case, we want to calculate EPS 1 year from now, right? So you want to calculate EPS 1 year from now. EPS 1. Is it clear? I'm just replacing the values here. EPS 1 should be equal to EPS 0, right? EPS 0, 1 plus your growth rate to the power what? 1. The same way, second one is cash flow, right? Here we need to know expected cash flow per share 1 year from now. So cash flow 1 year from now is equal to cash flow in year number 0, 1 plus G to the power 1. Same way, sales revenue per share is equal to what? 1 year from now is equal to sales revenue per share in year number 0, 1 plus growth rate to the power 1. Is it clear now? So the same formula is modified in each of these 3 cases. Okay. Now we know our current EPS. Let us go back. So here our diluted EPS, right? How much? $5.46. Diluted EPS. Then we also know the growth rate of our earnings. How much is that? 3.81%, right? So let us just put it here. So expected EPS 1 year from now is your current EPS 5.46 times 1 plus your EPS growth rate 3.81%. Clear? So with this one, you will get what? EPS 1 year from now. Basit, is it clear?
Yeah.
Okay. Then the value you're gonna get here is $92.50. Next, price to cash flow ratio. So the price to cash flow ratio we have here is 8.09, right? So put 8.09 times expected cash flow 1 year from now is here. So we have here free cash flow per share is how much? $9.82, right? So $9.82. Also, the free cash flow growth rate is how much? 40.69. Very good. So 9.82 then times 1 plus your growth rate 40.69 percentage. Then the value you're gonna get here is 111.77. Next, price to sales ratio. So the price to sales ratio you have here is what? 0.41. And then your sales revenue per share is how much? $204.67. Then your sales growth rate estimate is how much? 4%. So we are going to use these three numbers here. So your price to sales 0.41. Then your current sales revenue is $204.67. Then times 1 plus sales growth rate 4% equals to $87.27. Is it clear now? Okay. Now let us actually make our investment decision based on whatever value we just got here. Okay. So remember here we use different approach. So I'm going to summarize it in Excel file. So I'm going to just copy numbers, right? Nothing special. So here we first used DDM with sustainable growth rate. DDM with sustainable growth rate provided us $115.39. Then DDM with analyst forecasted growth rate is equal to how much? $42.72. Then residual income model with sustainable growth rate is equal to 119.94, and then residual income model with analyst growth rate is how much? $75.10. Then FCF negative 101.65, but you know we are not gonna consider this one, right? So this one will not be considered. Then PE ratio model actually gave us how much? $92.50. Then price to cash flow model actually gave us how much? $111.77. Then price to sales model provided us $87.27. So I just summarized the number, right? Now let us make our decision. So here we already know we cannot use this free cash flow one. So take it off. You see? Because my number here is what? Negative. Share price cannot be negative. So therefore, I just took it off from my decision making process. Is it clear, Basil?
Yeah.
Okay. Now, we got all of these numbers. Now what you can do? You can calculate median or mean, whatever you like. Mean means average. You can take the average of all of these numbers, or you can calculate median of these numbers. But for this class, let us do it for only for average. So we are going to use average. Now, how many numbers do you have here? 1, 2, 3, 4, 5, 6, 7. So you need to, because you have 7 numbers here, so you need to add up all of them and then divide it by what? 7 to get the average. Total sum, that means sum of everything, and then total number of values. How many numbers you have? So this will give you the average.
So would the average be the most accurate?
No, median will be the most accurate. But remember, some of you may get confused how to calculate median manual, but in Excel you can do it. But since this class is not Excel based, we are going to stick with the average. But in real life, if you really want to use all of this approach, always use median, not mean. Okay. But good question, Basil. Yeah, median average should not be used in this case. It should be median. 115.39 plus 42.72, 119.94, 75.1, 92.5, 111.77, 87.27, then divided by 7. Then our average share price is $92. Average. But out of curiosity, let us also calculate median. Let's see how much is that. Median $92.50. Now let us compare with the current market price. How much? $68.91. Now, based on whatever techniques we used here, it should be a buy or sell decision. Buy. Is it clear, Jenny? Okay. Now, in my real life, if you ask me how I am going to use this technique, once again, class is over. But this is something really interesting. So, as an investment banker, I'm just sharing my experience. Once again, if you use my technique and you make any loss, I'm not responsible. Those are standard words people need to say. Okay. So actually, CBS had some really good period in the year 2019 and 2020. Remember, because of COVID-19, actually all the retail stores we have made really good business. Remember, people actually stopped spending much for luxurious product like big car, good furniture, all of this. But we all have to eat, right, to survive, and we need regular medicine and everything. So therefore, actually, people actually transferred their spending from luxurious product to daily necessary products. Therefore, all of the giants like Walmart, Amazon, CVS, Target, they all made good business. Even all the food companies too, like Papa John's and others, right? So therefore, their last year earning growth rate should not be a benchmark for their future growth rate. Does it make sense? So therefore, here I prefer to stick with whatever the average analyst forecasted growth rate. Remember, we also collected the growth rate forecasted by the analyst. Remember? So here, so these are the growth rates which actually are forecasted by the analyst, average analyst in the market. So analyst actually forecasted how much growth rate for earnings? 3.81%. And they actually forecasted the growth rate for sales how much? 4%. So whatever techniques we actually used and apply, in whatever techniques we actually applied, these analyst forecasted growth rates should be the good benchmark. Is it clear? So remember here, let me now go back. Oh, where is? So here, this one, we use last year growth rate to calculate sustainable growth rate. So I'm not going to use it because I know last year growth rate should not be representative of future growth rate. But I'm going to use that approach which used analyst forecasted growth rate. So I just single it out. Next, residual income model. Then P ratio, price to sales ratio. Now I'll take median. So if somebody asks me which value I'm going to prefer, $81. So I'm not going to use this $92, whatever we used here. I mean, whatever median we calculated in the very first place. Okay, that's my personal experience. That's it. So thank you so much for, yes,
Why
Jenny.
didn't you use the price to cash flow in the second one that you did?
Which one, Jenny?
The price to cash flow.
Here?
Yes.
So I'm saying this one we used in the very first
Yeah,
example.
no, I get that, but like, why didn't you?
Oh, because I calculated the growth rate of this particular cash flow using the last year growth rate.
Okay.
So remember, whatever formula actually involves something from the very last year should not be a good representative, because we know they made some good business. Now, for example, once we get vaccinated, we all will return to our work, right? And then we are going to start using our money for luxurious product one more again. And thereby, this business will lose some money, and those money will go back to what? Luxurious business, like car and others. All right, thank you so much. And once again, I'm gonna post the video for today's class so that even if, 5 people actually joined the class online, even if somebody missed the class, they can watch the entire video and then contribute to your group project equally, okay? And also try to contact with your group members right now. In my experience, some students actually come back in the very last week, and sometimes they say they cannot actually communicate to their group members. They are not available. So if it happens at the very beginning, we have some room to work, right? But if you come back in the very last week, I don't have any other option.